Hi everyone, hope all of you are enjoying your festive celebrations. Today, I'll be talking more about a recent article we just published on the covered call option strategy. With the markets trading down this quarter and likely sideways in the near future due to the hawkish central banks, investors and traders like yourself might be wondering, how can we generate any sort of return in this market? Today, I'm going to show you how using covered calls. So, what is a covered call? A covered call is an option strategy that involves selling call options against a stock that you already own. This is considered to be a decent way to earn premiums without taking too much risk, as your downside is capped. For example, if you own Apple shares, you can sell call options against your Apple shares and receive premiums from the sale of these options. And because you own the underlying shares, you will be able to deliver these shares to the call option buyer should the option expire in the money. So how does this work? Typically, selling options is a risky strategy. However, in this case, because you own the underlying shares, the risk of this trade is greatly reduced. This is because the biggest risk from selling call options is when the underlying shares rise. If you do not own the underlying shares, you would be caught short the stock. However, selling call options on stocks that you already own will ensure you always have shares to deliver in the event the call option expires in the money. That way, you limit your risks while ensuring you can generate some income through the option premium. So what happens at the expiration of your covered call option? So it really depends on whether your option expires in the money or out of the money. If the option is in the money, it literally means that you are in for delivery. So you have to deliver the shares to the option buyer. If the option is out of the money, then you are out of stock. Therefore, you don't have to deliver the shares. An option would expire without any obligations. So let's look at an in-the-money example. Let's say you own 1,000 shares of stock A at $30 and the current price is $35. You do your intense analysis and find that stock A is overvalued at $40 and you don't mind selling your shares at $40. Therefore, you sell 10 call options at strike, $40 for some premium, say 70 cents each. For illustration purposes, I will assume stock A is listed in the US and each call option in the US represents 100 shares. So in total, in this case, you receive about $700. If at expiry the stock trades above $40, it means that you are in the money and therefore in for delivery. You will sell your 1,000 shares at $40 and so you make $10 a share for a total of $1,000 and you also get to keep your premium of $700. If the stock trades below $40, it means that you are out of the money and therefore out of stock. So you don't have to deliver shares. But you will still keep your premium of $700 and you have no obligation to the option buyer. So when are the best times to trade covered calls? So the best time to trade covered calls is really during a sideways or downward market. When the market is coming down, it is hard to generate returns other than dollar cost averaging your holdings. However, selling covered calls can give you some passive income while getting through the market winter. If the market is in a strong uptrend, you might not want to sell too many covered calls as you might lose your stock's upside potential for a small premium. You can, however, stagger the sale of your covered calls on the way up. Say maybe sell two call options every month, for example. So what are some of the key advantages of trading covered calls? Firstly, and most obviously, it generates passive income. You get to keep the premium you receive from selling these call options. Secondly, it is relatively low risk. As you own the underlying shares of the option, you are covered and hence protected from unlimited loss. And thirdly, you do not require extra margin to sell covered calls on the Saxo platform. And of course, with some key advantages, there are always some risks of trading any product, including covered calls. First of all, one of the key risks is that it caps your stock's upside potential. So if you sell a call with strike of $40 and the stock goes beyond $40, you might lose the potential upside. If the stock goes to $50, you could lose a potential upside of $10. And this is the risk of selling a covered call on your long holdings. Secondly, there is also a risk of using covered calls as a proxy for taking profit. For example, if you sell a call at strike $40, and the stock moves beyond $40 throughout the lifetime of the option. However, it falls below $40 on expiry. In this case, you will not be able to sell your long holdings at $40 as the option expired out of the money. However, if you do not have the covered call option, you might have taken profit at $40 by using a limit sell. Please also note that covered calls only work when you trade against shares and not CFDs. You do not get to enjoy margin offset for trading covered calls against CFDs. And this is because CFD holdings cannot be delivered to the call option buyer when the option expires in the money. So if you own the CFD now and you have sold some calls against that, one workaround is to consider replacing it with stock holdings closer to the expiry date if the option is likely to expire in the money. So over here we have put up a profit and loss scenario table by comparing the P&L difference between holding 1,000 shares outright at $30, selling calls at strike 40, and of course holding both long 1,000 shares as well as selling covered calls against them. And you would see that through the different profit and loss scenarios, that when you own shares, when you own shares and sell covered calls against them, you would be better off if the stock moves in a sideways fashion, and slightly better off when the market falls due to the premium earned. However, if the market goes straight up, you would lose on upside gain beyond $40. So on this note, this is all for today. We hope you enjoyed this little clip on covered calls. Do click the link in the description below to access the article, and we wish you all the best in your trading.